All right, welcome back to the deep dive. We've made it to the final part
Part 3.
of our exploration of Christine Jonick's Principles of Financial Accounting.
It's been a journey.
It has. But we've learned all the building blocks.
We
And now it's time to put on our detective hats
Yeah.
and learn how to analyze
Right.
financial statements.
Yeah, because now we can actually see how it all comes
All
together.
right, like how those pieces fit together to tell the story
Exactly.
about a company's financial health and performance.
And Jonick gives us all these really cool tools to do that.
Okay.
She talks about horizontal analysis, vertical analysis,
Yeah.
and ratio analysis. So it's like we have all these different lenses
Okay.
that we can use to look at the financial data.
Gotcha. So let's start with horizontal analysis.
Okay.
What is that?
So horizontal analysis is basically just comparing financial data over time.
Okay.
So you could compare this year's income statement to last year's income statement.
Okay.
Or even go back further and look for trends over several years.
Yeah.
It's kind of like if you're watching a runner
Yeah.
and you're looking at their lap times over multiple races.
Right.
You can see, are they getting faster? Are they staying consistent? Are they slowing down?
Right. So we're looking for those changes in patterns.
Yeah.
Not just the absolute numbers.
Right, exactly.
What are some red flags that we might find with a horizontal analysis?
Well, if you see that a company's sales are growing,
Okay.
but their profits are shrinking, that could be a problem.
Right.
Or if their debt is increasing way faster than their assets,
Yeah.
that could be a cause for concern.
Okay.
So horizontal analysis can kind of point those things out to us.
Right.
So we can dig a little deeper.
Now, what about vertical analysis?
Oh.
How is that different?
So with vertical analysis, we're not comparing numbers over time.
Okay.
We're looking at the proportions within a single financial statement.
Okay.
So, for example, on an income statement, you could express each expense as a percentage of sales. So then you can see how all the different expenses kind of relate
Right.
to the overall cost structure.
So if a company's marketing expenses went from 5% of sales to 10%,
Yeah.
it's a pretty big jump.
That's a big change. We'd want to know why that happened.
Okay.
So vertical analysis can help us understand,
Yeah.
the relative size and importance of
Yeah.
all those different pieces.
Okay, now let's talk about ratio analysis.
All right.
This is where it starts to feel a little bit more technical.
It does, but ratios are super useful because they let us calculate relationships between different financial numbers. It's like using a magnifying glass to zoom in on,
Yeah.
really specific aspects of a company's performance.
What are some of the insights we can get from using ratios?
Oh, there's tons of different ratios.
Okay.
Each one tells us something different. But for example, there are profitability ratios. Those tell us how efficiently a company is making a profit.
Right.
There are liquidity ratios, which tell us how easily they can meet their short-term financial obligations.
Okay.
And then there are solvency ratios, which look at the long-term stability.
Those all sound really important
They are.
to know about a company. Okay, so can you break those categories down a little bit more?
Sure. So profitability ratios.
Yeah.
A really common one is profit margin,
Okay.
which basically tells you what percentage of each sales dollar is actually profit
Right.
after you've paid all your expenses.
So a company with a profit margin of 10%
Yeah,
keeps 10 cents in profit for every dollar of sales?
exactly. And the higher the profit margin, the more profitable the company.
Right. Okay, what's another one?
Another important one is return on equity.
Okay.
And that measures how well a company is using its shareholders' investments
Okay.
to generate profits.
So it's how much
Yeah,
bang for their buck are the shareholders getting?
exactly.
All right, now what about liquidity ratios?
So liquidity ratios, one of the most common is the current ratio.
Okay.
And that compares the company's current assets to its current liabilities.
And current assets are things that can be converted to cash.
Right. So cash on hand, accounts receivable, inventory, and then current liabilities are short-term debts that are due within a year.
Gotcha.
So the current ratio basically tells us if the company has enough liquid assets to cover those short-term debts.
So a current ratio of 2 means they have twice as many
Yeah.
assets as liabilities.
Exactly.
That seems like a good thing.
It usually is. A higher current ratio means they're more likely to be able to pay their bills on time.
Okay. All right, what about those solvency ratios?
So those are looking at the long term.
Okay.
Can this company stay afloat for the long haul?
Yeah.
One of the most common is the debt to equity ratio,
Okay.
and that compares total debt to stockholders' equity.
So how much debt are they using to
Right.
finance their assets?
Exactly. So a really high debt to equity ratio can be risky
Okay.
because it means the company is relying a lot on borrowed money.
Right.
But a really low debt to equity ratio might mean they're being too conservative
Okay.
and they're not taking advantage of opportunities to grow.
All right, so it's all about finding that balance.
It is, yeah.
Okay, so those are just a few examples of ratios, but it sounds like ratio analysis is like this really powerful tool
Yes.
for understanding a company's financial performance.
Absolutely. You can spot those red flags. You can see where they might need to improve.
Right, so it's like we have this secret decoder ring
Yeah,
for the financial world.
you got it.
But I imagine it takes some practice to
Yeah.
learn how to interpret all those ratios.
It does, and it's really important to remember that no single ratio is going to tell you the whole story.
Okay,
You need to look at multiple ratios,
right.
compare them to industry averages, look at historical trends,
Yeah.
and you also need to think about those qualitative factors.
Okay.
Like who's running the company, who are their competitors,
Yeah.
what's going on in the economy in general.
Right, so it's not just like plugging numbers into a formula.
No.
You need to use some judgment.
Yeah, you got to think critically
Right.
about the results.
This has been an incredible deep dive
It has.
into the world of accounting.
Yeah, we learned a lot.
We learned about the accounting equation, the
Yeah.
accounting cycle,
Right.
different types of accounts.
All sorts of different accounts.
So specialized areas like payroll and bonds.
Yeah.
And now we've even explored how to analyze financial statements.
Yeah. It's a lot.
It's a lot, but it's so fascinating.
It is. It's amazing how much accounting really touches
Yeah.
every aspect of business.
And that's what makes it so important to understand.
Absolutely.
So as we wrap up this deep dive,
Yeah.
we just want to encourage everyone to keep exploring,
Yeah, keep learning
keep asking questions.
and keep those financial minds sharp.
And we'll see you on the next deep dive.